Professors FM.
Hey there, tax nerds. Before we dive into the episode, check out Fanalytics with Mike Lewis of Emory University. Like us, Mike breaks down complex topics, but for the world of sports. Explore player performance, fan loyalty, and even non-sports fandom. It's also a part of Professors FM, the podcast network making sense of the world with top scholars.
I'm Bridget Stomberg.
And I'm Lisa DeSimone.
And this is Taxes for the Masses.
Today's episode is on the qualified business income deduction found in Section 199 Cap A.
As part of the Tax Cuts and Jobs Act of 2017, Congress created a new deduction related to qualified business income from pass-through entities such as partnerships and S corporations. In today's episode, we discuss the deduction in light of a February 2024 report by the Congressional Research Service that examined the deduction's effect on investment and employment, equity, and taxpayer compliance.
Hello, Bea.
Hello, Lisa.
So I'm going to call this one another spring cleaning episode. We're cleaning out the basement today.
Charles, what now?
Well, there's been a lot that's been going on in the tax world in the last 5 to 6 years. Too much for our little, semi-monthly podcast to stay on top of. Mm-hmm. And so as a consequence, we accumulate some extra episode ideas. And I feel like we only recently are getting around to some of those big topics.
Okay, so I get the spring cleaning metaphor now.
Okay.
But also, are you saying we should record more frequently?
No, thank you. I'm good.
Ouch. Oh, my heart. Got it. Okay. So we're continuing to clean out the basement, which I guess we're analogizing to our episode idea checklist.
Yes. Mm-hmm.
And we're going to do that today by talking about the deduction for qualified business income, which is not too creatively known as the QBI deduction.
Yeah.
Qualified business income.
Really had to reach on that one.
It is what it is. So there's a lot to say about this deduction.
Okay.
And I think that, at least from my perspective, one of the reasons we probably haven't touched on this earlier is because it's really complicated.
It's really, really complicated.
Like, I've taught it a couple times and immediately afterwards I flush it all out of my brain.
So I teach it as well. And I created this amazing flowchart. Like it took me hours and I put it all together and then realized none of my students are going to look at it.
Yeah.
Yeah.
So lots of triggering feelings that the QBI deduction brings about. So for tractability and to not drive away our listener base, all four of you, we're going to focus our discussion about the QBI deduction on a recent report that was issued by the Congressional Research Service. And that report examined a couple of dimensions of the deduction, including how it affected, first, investment and employment, second, vertical and horizontal tax equity, which we've talked about quite a bit on this pod, and lastly, tax compliance and administration.
Exactly. So just like with spring cleaning, we can't tackle the whole house at once. So we're just going to focus on one little area of it. Love it. Question though.
Okay.
If this deduction has been around since 2017, why are we just now getting a report? Okay. Scratch that. Different question.
Okay.
Why do we need a report at all?
Okay. So those are both excellent questions. So let me try to answer both. I'm going to start with the last question first. Why do we need a report at all? I think one reason is because the deduction is actually set to expire or go away in 2025, unless Congress does something to extend it.
Okay.
So I think we need a report, research something to understand if the deduction is working as intended. And if it's not, Congress could either modify it in the hopes of improving it or just let it die in 2025 if we decide that it's beyond redemption, which we might do by the end of this episode. Why it's taken us so long is, we needed some time to pass to have data available to analyze its effects. And it turns out that the IRS and Treasury and related government agencies aren't so quick with the data analysis.
Got it. Okay. All right. How should we start?
I guess we can start by asking the question that I normally ask when I'm knee deep in clutter that I'm trying to rid my house of, which is, how did we get all of this crap in the first place? How did all of this stuff get here?
as you look accusingly at your husband.
Exactly.
I imagine. Yes.
Yeah.
Mm-hmm. Mm-hmm. All right. How did we get here? The QBI deduction is found in Code Section 199 Cap A, which Congress implemented as a new provision as part of the Tax Cuts and Jobs Act in 2017. And a hallmark of that act was that it reduced the federal burden on business income. And one of the ways it did that was by cutting the corporate tax rate from 35% to 21%.
So sidebar, why do some code sections have a big letter next to them?
I don't know.
We got to figure that out. All right. So yeah, TCJA wanted to tax business income at a lower rate, but not all business income is earned through C corporations. But about 95% of all businesses are not C corporations. They are pass-through entities like partnerships and S corporations. The income earned by these businesses is not taxed at the entity level. Instead, the income, quote, passes through and is taxed by the owners, many of whom are individuals. Mm-hmm. Ultimately, all of that income should trickle down to an individual. Mm-hmm. Therefore, much business income in the U.S. is taxed at individual tax rates, not corporate tax rates.
While the TCJA also lowered individual tax rates, it didn't lower them by nearly as much as it lowered the corporate tax rates. So, for example, the top individual tax rate dropped from 39.6% to 37%.
It's not big.
Yeah. But even though the corporate tax rate is lower than the top individual rate, it's not all bunnies and hay for C corporations.
Okay.
And that's because corporate income is subject to double taxation.
Yes.
Right? It's taxed once at the corporate level at that now 21%. And then again at the individual level when the corporation distributes cash to its shareholders or repurchases their stock. So income from C corporations taxed twice. Yep. Income from pass-through entities only taxed once.
This is already getting complicated.
It is. So to keep things simple, let's just ignore the double taxation of C corporation earnings for a second and we'll do a quick example.
Okay, as you wish. So before the TCJA, $1 of corporate profit would yield 65 cents of after-tax cash flow at that 35% tax rate.
Got it.
In contrast, $1 of pass-through income passed through to an individual in the highest tax bracket would yield only about 60 cents of after-tax cash flow. That's fairly similar. 65 cents, 60 cents. We're not too close. It's close. And that's good because we don't want tax distortions to exist just because of how a business is legally organized.
Right. But after the Tax Cuts and Jobs Act's corporate tax cut, $1 of corporate profit would yield 79 cents of after-tax cash flows, whereas $1 pass-through income passed through to an individual in the highest tax bracket would yield only 63 cents of after-tax cash flow. So 79 versus 63, quite a bit different from 65 versus 60.
Yeah, that doesn't feel as similar as it did before.
Nope.
Okay. So I'm going to say something here.
I'm a little concerned.
Okay. We give Congress a hard time.
Yeah.
On this podcast.
Yes.
A lot. But they realize this.
Even a broken clock is right twice a day.
Okay. They realized it.
Okay.
And they introduced the QBI deduction as a fix to establish more similar treatment between $1 of business income earned by a C Corp and $1 of business income earned by a pass-through entity. I'm trying to be generous here.
I see where you're going with that now. Okay. Yep.
The QBI provides a deduction. The maximum deduction is equal to 20% of qualified business income from a pass-through entity. So with that in mind, let's redo that post-TCJA example to see how this works in practice.
Okay. $1 of corporate profit still yields 79 cents of after-tax cash flow because the QBI deduction does not apply to C corporations.
Check.
But now, if a pass-through entity earns $1 of business income and it's all qualified, then only 80 cents of it is taxed. At that highest individual rate of 37%, now the tax would be about 30 cents. So the after-tax cash flow of that $1 of pass-through business income is about 70 cents.
So we're closing that gap between the after-tax cash flow of $1 earned by a C Corp and earned by a pass-through entity.
Yep.
All right. So we're closing the gap, but we're not eliminating the gap. So the QBI deduction isn't perfect.
Okay.
It doesn't get the difference back to where it was before the TCJA, which is only a 5 cent difference. but it does lower the tax rate on pass-through business income more substantially. So with the QBI deduction, the tax rate on pass-through business income declines as a result of the TCJA by about 25%.
Okay.
From a top rate of almost 40% to closer to 30%.
Okay.
Now, C corporations got a 40% reduction, so they're still ahead of the game, but we have to remember that corporate earnings are also potentially subject to that double taxation.
Oh, that's right. Yeah. Okay. So this seems great. Congress gave a benefit to C corporations, realized that it was much larger than the benefit that they were giving to pass-throughs, so they created this new QBI deduction to equalize things a bit. What could there possibly be to complain about?
Hold my avion. All right, we've talked about the purpose of the QBI deduction generally. Now let's turn our focus to that Congressional Research Service analysis of the deduction's economic effects.
Okay. So from 2018 to 2021, almost 90 million taxpayers have claimed the deduction.
That's a lot.
That's a lot. And aggregate claimed tax benefits have exceeded $675 billion.
Okay, so we've learned that this is a popular deduction.
It's a popular deduction.
All right, so let's talk about how it affected investment. And we might be asking yourself, why do we care about how this deduction affects investment? So we have to remember that the TCJA's argument of why they wanted to lower business taxes was because if we lower business taxes, we're going to spur investment.
Yes.
We're going to increase productivity, and all of that is ultimately going to lead to higher employment and wages. So investment is really the first step to more money for everybody else.
Yes. Trickle down economics. Yep.
Okay. So that makes sense. Did it work?
We don't know.
Wah, wah. What?
Well, so there's no study that examines the link between the deduction and non-corporate business investment.
Okay.
But there are some studies that suggest it should spur investment, even though the deduction itself is not directly tied to investment.
Okay.
Because the deduction isn't an investment subsidy.
Okay. So in theory, it should work. We don't have any evidence whether it did work or not. All right. So I'm not thinking that that is going to bode super well for these increased number of jobs and wages. If investment was the doorway, the gateway to more jobs and better wages, how are we doing there? How is the deduction affecting employment and wages?
So it's not a job subsidy either.
Okay. So it's supposed to spur investment, employment, and jobs, but it is neither an investment subsidy nor a job subsidy. Okay.
Yeah.
Great. Continue.
So no study shows how businesses are spending the $675 billion of tax savings from the deduction. Are they using it to create more jobs? We don't know.
Okay. All right. This Congressional Research Service report doesn't seem to be chock full of information, but
nope.
Okay. Does the report tell us anything about employment and wages?
It does point out that the design of the deduction makes it unlikely that it incentivizes job growth in many instances.
Okay.
It's complicated, but in a nutshell, there are situations in which a lower income pass-through business owner can claim the max deduction, even if they don't create any new jobs.
Oh, that's not going to make an incentive work if you get all of the thing without doing any of the thing. Okay.
And a higher income pass-through business owner can't claim the max deduction regardless of how many jobs they create.
Okay. So just want to recap, make sure I'm following here.
Yeah.
We lowering taxes to spur investment, which is then going to lead to job growth.
Yeah.
We created this deduction that is, if you don't make enough money, you get all of the benefit without creating any new jobs. And if you make too much money, you can't get any benefit regardless of how many jobs you've made.
Yeah.
Okay. So we're not doing great theoretically when it comes to those two things. But the problem is we didn't have anybody to actually analyze the relation between those two things. So it's unclear.
Right.
All right. How about tax compliance and administration? I think that this is an area where we're going to have more direct evidence. So the first thing that we need to know, which we've already alluded to, is that it's a really freaking complex calculation.
It is.
Second thing we need to know is that it's not so simple, and not all businesses qualify.
Right. Yeah.
So the rules for qualification are actually going to differ depending on the size of the business. And there are also multiple limits that you have to worry about.
Sounds like that might make it so that businesses are uncertain if they even qualify.
Yes, roger that. It also increases the cost of compliance because you have to understand the rules, collect the information needed to figure out if you qualify, and then do the calculation, and then actually report the calculation on your tax return, et cetera, et cetera.
Yeah. Estimated compliance costs for those who claimed the deduction in 2021 were $17.8 billion for hiring tax professionals and time spent collecting information and, filling out the complex calculation of the deduction.
That is so much money.
It is. It is.
So maybe based on all of this terrible stuff that we've just been telling you, you might expect that the take-up of the deduction was lower than it was forecasted to be when the provision was put into place. So our favorite, the Treasury Inspector General for Tax Administration, estimated that almost, wait for it, 900,000 taxpayers appeared to be eligible for the deduction based on the information they filed in their 2018 tax returns, but didn't claim it. Tell us, Lisa, why would a taxpayer not claim something that they're eligible to claim?
Either they don't know that they're eligible, or they do know, but they can quickly do a little bit of math and it's not worth it. It's not worth their time and energy to try to do it. Or maybe they don't do the math, but they just don't even want to go there.
When a calculation is this complicated, sometimes the taxpayer can't even figure out how much benefit they would qualify for.
Right.
And so then you're in a position of saying, am I going to pay my tax professional X number of dollars to tell me that I qualify for 44 cents of a deduction?
Right.
All right. So from a compliance perspective, it's complicated, and that means it's costly. From a tax administration perspective, things are not looking much better. So I'm not sure if you've heard this, but the IRS is underfunded. That
I've heard that once or twice.
Just want to make sure. And so because of that, they sort of tend to look for easy wins on an enforcement perspective.
Yes.
Well, they're not really likely to find those here. So 28% of QBI claims were from taxpayers that had at least $200,000 in taxable income. So these are fairly high wealth individuals, high income individuals. So they make up 28% of the claims, but they make up 76% of the tax benefits claims.
Oh, wow.
And the computation is more complex and therefore more prone to errors and abuse for these higher income taxpayers. So what we know about the IRS, because they like these easy wins, they're more likely to go after things that are called correspondence audits, where they can just write you a simple letter, ask you a simple question, and you can provide them a simple response.
Right.
For a high income taxpayer claiming the QBI, this probably isn't going to be figured out with a correspondence audit. Which means that the IRS is probably not auditing these things at all, or auditing them at a lower rate. And that means that the IRS is unlikely to uncover errors and reclaim underpaid taxes of these high wealth individuals.
That's not good.
Boo.
Yeah.
All right. Things are definitely going to get better when we talk about equity, right?
Yeah. It doesn't sound like it, right? If higher income taxpayers are capturing a disproportionate share of these benefits, that's not great.
It's not.
And if we dig deeper, 61% of the benefits went to the top 1% of the income distribution. The bottom share only got 4%.
And that doesn't sound great on its face, and it's not, but it's not necessarily the fault of this deduction. It more stems from the fact of something we call the distribution of pass-through income, which we know is disproportionately going towards higher income individuals. So if higher income individuals are more likely to have pass-through business income, they're more likely to qualify for this deduction.
Right.
So that's sort of from a vertical equity perspective when we're talking about taxpayers of different income levels.
Okay.
But we also have to think about horizontal equity. What do you want to tell us about that?
Well, a single person who earns $100,000 with wages pays 22% top tax rate, but a single person who earns $100,000 of flow-through business income would pay only 17.6%.
So you're telling me that there's no horizontal equity there?
Doesn't sound equitable to me.
I don't think so. So we're going to call that hosed.
Okay.
We're going to say horizontal equity is further hosed because of the weird and complex rules about which businesses qualify.
Okay.
So let's get away from low income people for a second. Even if you're a high income taxpayer, if you're engaged in a business like accounting, law, athletics, or financial services, you actually get no QBI deduction if your income is high enough. But if you are a high income earner not involved in any of those services, you might still get a deduction.
So complicated.
And unnecessarily so. All right, time for the good, the bad, and the ugly. We just said a lot of bad stuff.
Yeah. Mm-hmm. Is there any good stuff?
There was something about cleaning. I like to clean.
Spring cleaning.
Spring cleaning is
cleaning
good.
out our basement.
We like a clean basement.
Yeah. That's good.
Okay, I'm going to go back to the thing that I tried to say.
Okay.
Which is that I like the idea that Congress tried to give all businesses a tax rate cut. Like they realized that corporations and pass-throughs are different. You can't give a 40% windfall to corporations and like a 2% windfall to... They tried.
Yeah. So are you in favor of the corporate rate cut then? Was this a good idea?
Well, that's totally unclear. But if we were going to sail down that road, at least we sailed down it for everybody.
Okay. All right.
I like the fact that Congress acknowledges that not all businesses are C Corps and was trying to help everybody out.
Agreed.
Good thing. Okay. I also think we did a pretty good job of breaking down a complicated issue with some help from the Congressional Research Service.
Yeah, I'm going to wait to see what our listeners think of that, but sure.
Okay.
Based on that report, though, I would say a bad thing is that we don't seem to know a lot about the effects of this.
Yeah, the Congressional Research Service, and I'm not trying to throw shade at them, but there wasn't a lot of research.
No.
It was more accumulating research that others have done, and unfortunately no others have
done that. Yeah.
I also want to say that I think this goes back a little bit to the IRS problem. So the IRS budget affects not only IRS enforcement, but it also affects IRS research. And I think that that's an area that maybe people don't always think about. So just want to put that out there, that when we think about cutting the IRS's budget, it's not just from an enforcement or even a taxpayer service perspective. It also prevents us from learning how effective the tax provisions that Congress puts in place are and knowing how to improve them. So that's not great. I want to call that a bad.
I'm going to say another bad is just how stinking complicated the provision is.
Yeah.
Like, can we simplify it just a bit?
Agreed. Okay, are we ready for the ugly?
Bring it.
I think the biggest thing for me is that this is yet another tax benefit we've talked about that, sounds awesome. And I'm sure that when Republicans were talking about it, they were talking about it benefiting some dry cleaner in small town America. But it's just another one of those tax benefits that seems to be disproportionately benefiting the wealthy.
Yeah.
Like by a lot. And that's a problem because this is a costly provision, right? This is cutting back tax revenue. And I don't know that we want to be doing that for something where the vast majority of the tax benefits are going to those in the top 1% of the income distribution.
Preach.
So I guess I could call this a good. I don't know.
Okay.
We'll see how it goes. I like it when we don't just poop on things for the sake of pooping on things, but we talk about ways to make it better.
Okay.
And so I did appreciate that the Congressional Research Service at the end of this report offered a whole section called policy options.
Okay.
So it was like, here's what's wrong with your crappy deduction, but then here are some things that you could do.
I like this.
So let's try to go out on a high note.
Okay.
So one of the things they said is that Congress could just let it die.
Right. Yes.
Bury it in the backyard.
Yep.
Another thing that we could do is just keep it as is and permanently extend it.
Okay. That sounds expensive.
Not sure why we would do that because it's estimated to cost $1.7 trillion over the next 15 years.
Okay.
Another thing we could do is permanently extend it, but fix it.
Sure. Okay.
So sign me up for that. Let's lower the compliance cost.
Yeah.
And some ways that the report thought that we could do that is by making it a flat deduction.
Sure.
Regardless of the type of business you have. So we're not treating lawyers and athletes different than dry cleaners and pipe fitters.
Yeah.
You could also create a simplified deduction that was more directly tied to things like investment and jobs. And lastly, we could get creative and just find another way entirely to tax non-corporate business profits.
That sounds hard.
It does, but I'm sure somebody's up for the challenge.
That's fair. Well, that's all we have time for today.
Be sure to join us for more tax nerdery on future episodes of Taxes for the Masses.